So, what do the supply chain disruptions and the rise in energy costs mean for the Federal Reserve? Well, unfortunately, we're not going to get any rate cuts this year. Coming into this year, there was still optimism we'd get about 2 rate cuts at some point this year. Well, they're off the table. In fact, there are some that are pricing in rate hikes. We're not there yet because we do think that once that Strait of Hormuz gets operating again, that we can get some of this supply chain disruption cleared up. This is not COVID. I do want to reiterate this. This is not a situation that's going to go on for years with supply chain disruptions. We will get this operating normally. But in the near term, we do think that this is inflationary. And in fact, when we were coming into this year, we had already started to see some inflation pressures emerging. The core PCE had been rising for several months, and this was before the war even broke out. So we do think inflation is a bigger concern than it was just a couple months ago. The Fed has made this clear. They've shifted their focus from the labor market to inflation. They've taken more of a hawkish stance. So they're basically telling us they're going to remain on hold. And if you look at this chart, this is showing you that the labor market has weakened, but it's not collapsing. And in fact, layoffs are starting to slow. So it allows the Fed and gives them the flexibility to just sit tight and wait. Now, we know we have a new Federal Reserve chairman that's likely coming in. It's important to remember that he does tend to lean on the hawkish side, and he has made comments recently concerned about inflation. Now, like I said, we don't think rate hikes are on the table yet, but if the inflation proves to not be a temporary issue and it goes into the second half of this year, we wouldn't rule that out either.